You walk into the same grocery store, same aisles, same shelves, same brand of eggs, but the price tag looks like it got promoted. And you do what everyone does after a crisis ends. You wait for prices to go back to normal, because that's how it works, right? Gas spikes, then drops, flights surge, then cool off. A shock hits, and then the economy resets. Except it doesn't. Not anymore. Prices go up fast during the crisis, and then they just stay there, like the crisis never left. And here's the uncomfortable truth. Prices don't come back down for one hidden reason. Not greed, not inflation expectations, not some mysterious supply chain ghost. It's simpler than that, and it's worse. Because once you see it, you'll realize the system is designed to make temporary price increases permanent. Let's start with a scene you probably lived through. A crisis hits. It could be a pandemic, a war, a shipping disaster, a fuel spike, a drought. Suddenly, everything gets more expensive. Food, rent, electricity, insurance. Your morning coffee somehow jumps 20% like it just learned capitalism yesterday. At first, everyone accepts it, because it feels logical. Of course, prices are higher, supply chains are broken, and then slowly things improve. Ports unclog, factories reopen, shipping rates fall, oil comes down from the moon. So you think, okay, now we go back. But at the store, the price tag doesn't move. It just sits there, quiet, confident, permanent. And that's where the real story begins. Because the mystery isn't why prices go up during a crisis. The mystery is why they don't fall when the crisis is over. Here's the official explanation you hear. Inflation is sticky. Labor costs are higher. Consumers are still spending. It takes time to adjust. All of these are partially true. But they don't answer the main question. If costs drop, why don't prices drop? If a company raised prices because shipping got expensive and shipping becomes cheap again, what exactly is stopping the company from lowering prices? What's the force holding that price tag in place? The answer is a mechanism almost no one talks about. Because it's not dramatic, it's not a scandal, it's a quiet rule of survival in the modern economy. And it's called downward resistance. Prices are like escalators. They go up automatically. But going down, that requires someone to press a button. And nobody wants to be the first one to do it. Let me show you how it works, step by step. Imagine you run a company. Doesn't matter what you sell. Cookies, cement, car parts, phone plans, toothpaste. A crisis hits, your costs rise, ingredients, transportation, energy, packaging, wages. You're under pressure, so you increase prices. Maybe 10%, maybe 20%. Customers complain, but they still buy. Why? Because they're seeing higher prices everywhere, so your price increase blends into the chaos. It looks normal. Then the crisis eases. Your costs start to fall, and now you have a decision. You can lower prices again, or you can keep them where they are and enjoy higher profit. And this is the moment most people think is about greed, but greed is too simple. The real reason companies don't lower prices is because lowering prices is dangerous. Not morally dangerous, financially dangerous. Because once you lower a price, you might never be able to raise it again without backlash. So instead of thinking, how do I give customers relief? Companies think, how do I avoid getting trapped? Here's the first hidden force, your competitors. If you lower your prices, one of two things happens. Best case, your competitors keep prices high. Customers notice you're cheaper. You gain market share. Sounds great. But here's the problem. Your competitors are not asleep. They will respond. They might cut prices too. They might start promotions. They might increase marketing. They might copy your move. And now the entire industry is in a price war. And price wars are like house fires. They spread, they get out of control, and everyone ends up poorer. So most companies follow an unspoken rule. Don't be the one who starts lowering prices, even if you could, even if your costs fell. Because the moment you make it a competition, you've turned your own product into a commodity. And commodity pricing is brutal. Nobody wins. Everyone bleeds, and eventually the weakest companies disappear. So price cuts become a last resort, not a normal response. Second force, customers don't reward price cuts the way you think they do. This part is uncomfortable. If you lower prices by 10%, most customers don't throw a parade. They don't say, "Wow, this company is so generous." They say, "Finally," or worse, "Why were you charging me that much?" It doesn't generate gratitude. It generates suspicion. Because price drops create a new story. They were overcharging. And companies hate that story. Price increases can be blamed on inflation. Price cuts can't be blamed on anything. It's like you just admitted you didn't have to do it in the first place. So instead of lowering the price tag, companies find other ways to give value without dropping the official price. They do coupons, bundles, limited time offers, loyalty programs. They keep the sticker price high and quietly discount only for some people, which means the official price level stays elevated, even when costs fall. Third force, modern businesses are addicted to predictable growth. This is the part nobody says out loud. A company isn't just a company anymore. It's a machine designed to satisfy investors. And investors don't just want profit. They want profit this quarter, and next quarter, and the quarter after that. So imagine what happens if you raise prices during a crisis, and profits jump. Even if the crisis was temporary, the profit boost becomes real. And Wall Street treats real profits like a new baseline. So now the company is trapped. If they lower prices again, profits fall. And Wall Street doesn't see that as returning to normal. Wall Street sees it as the company is weakening. The stock drops. Executives get blamed. Budgets get cut. And companies will do almost anything to avoid that headline. So they keep prices up. Not because they're evil, but because the system punishes them for going back. Now we reach the hidden math, the thing that quietly locks prices into place. And once you see it, you'll stop expecting prices to come down. Because the real mechanism is this: inflation changes the entire cost structure permanently, even after the original crisis ends. Let's say shipping costs rise for 6 months. Maybe they double, maybe they triple. A company raises prices, then shipping falls back. But during those 6 months, the company also adjusted everything else. They raised wages to retain workers. They signed new supplier contracts. They increased financing costs because interest rates rose. They upgraded systems. They changed packaging. They paid more for insurance. They faced higher rent. They ran more expensive marketing because ads got competitive. So even if shipping returns to normal, not everything resets. Some costs are sticky, and some costs are now permanently higher. But here's the key detail. Even if all costs return to normal, companies still wouldn't drop prices because they've discovered something priceless. Customers can survive the higher price. That's what the crisis teaches them. The crisis is like a stress test. It reveals the maximum people will tolerate. And once you learn that number, you don't forget it. Now let's talk about the most annoying part. Sometimes prices don't just stay high, they actually keep rising even after the crisis ends. And that feels insane. But it happens for one reason. Prices follow the highest pressure point. During a crisis, the public is distracted. Governments are busy. Media coverage is chaotic. People are panicking about bigger things than a price tag. So companies adjust pricing aggressively. Because they can. Then when the crisis fades, the new price has already been normalized. So the next increase doesn't feel like a crisis increase. It feels like a regular increase. A small step, a little nudge, a routine update. And inflation becomes a staircase, not a spike. Now let's add the part nobody wants to say because it sounds rude. Sometimes prices don't come down because you're still paying them. That's it. Not as a moral judgment, as a mechanical reality. Companies don't set prices based on fairness. They set prices based on what the market will absorb. If people keep buying, the price is correct, no matter how painful it feels. And what's ironic is this. When prices rise, we complain. But most of us don't change behavior fast enough. We might switch brands once or twice, but we still buy the same categories, still eat the same foods, still pay the same subscriptions, still live in the same cities, still finance the same lifestyles. So the market learns something even darker. People will adjust their budgets before they change their habits. They'll cut savings. They'll stop investing. They'll delay health care. They'll take on debt just to keep life feeling normal, which means higher prices don't just stick, they spread. And now we zoom out. This is bigger than grocery prices, because once prices stay high after a crisis, something else happens. The psychological floor rises. Businesses start planning around the new normal. Workers demand higher pay just to survive. Landlords anchor rents to the new level. Governments collect more tax revenue because everything is priced higher. Banks adjust lending models. Insurance companies adjust risk tables. And suddenly, the entire economy is built on a higher platform. Even if the original shock is gone, the crisis becomes permanent in the structure, not because the crisis continues, but because the system adapted to it and refuses to unadapt. So here's the contrast. The hype version of inflation is prices rise because of temporary shocks. The reality is, temporary shocks are the easiest time to permanently reset prices. That's the hidden reason prices don't come back down. A crisis is not just damage, it's permission. Permission for the entire economy to reprice itself upward. And once it does, going backward is treated like failure. Now you might be thinking, okay, so prices never come down? Not exactly. Some prices do fall. Tech products can fall. Certain commodities drop fast. Gas can swing. Some goods get cheaper when supply explodes. But the prices that matter most, the ones that define your life, rent, food, healthcare, education, insurance, utilities, those are the hardest to push down because they're tied to systems that move slowly and because they're protected by that downward resistance. They rise like rockets and fall like feathers, which leads to the real question. The question nobody asks out loud. If the system is designed to lock in higher prices after every crisis, then every crisis isn't just a temporary emergency, it's a step upward, a ratchet, a one-way mechanism. So the next time a crisis hits and prices spike again, and everyone says, "Don't worry, it's temporary," you should ask one quiet question. Temporary for who?